Good day, Industrial Advisors listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. Bill Condon and Matt McGregor. We're going to talk about Q2 and what's going on in the marketplace. We want to touch on three dynamic factors that are impacting the Puget Sound region right now, and then we'll give you an opinion at the end. But a lot has changed, in the last quarter, and first and foremost, rising interest rates, right? You look how things have changed over the last 90 to 120 days. That has been the single biggest impact in our marketplace. Wouldn't you agree, Matt?
Yeah, I mean, even the last few weeks, maybe the most dynamic changes in a small period we've ever seen.
Yep.
Right? It's crazy what's happened. Let's start maybe with the capital market. So I guess the first dynamic impact is interest rates, but what does that mean? Capital markets are in a strange position. Like we're seeing the biggest spread of offers. We're still seeing the same amount of offers. We're still seeing the same amount of interest. It's just, I think people are having a real challenge underwriting while these interest rates are moving with the same dynamic that we've been seeing for years, which is great demand. So how do you balance that? Wait a minute, the market's red hot. We're still seeing demand. We're still seeing vacancy drop. We're still seeing all of this, but interest rates are impacting sales.
They certainly are. And I think that, as time has gone on and rates have continued to climb, the depth of buyers may not be what it was, clearly, right? Some groups are just in a holding pattern, right? And seeing, okay, how is this going to play out, right? Mm-hmm. And we are still, trading the buildings that we have out on the market. We have quite a bit of product out, and we've traded quite a bit so far this year. But it's certainly having an impact on how groups are underwriting things, how they're looking at it, how they're looking at exit caps. It's also had a big impact on how developers are looking at land cost. I think that's one of the biggest things.
Well, you were in the same conversation I was with one of the most respected developers we know. We won't name any names, but that particular well-known company and person felt land has maybe been impacted over the last several weeks, up to 50% of its value.
Yep. In certain submarkets, for sure. Yeah.
Right. Which is crazy. But you're right. If you dissect everything in the market going on, land and development is the biggest question, and we've seen now several pieces of land either get substantially retraded or walked away, right? We found out another one this morning.
Yeah.
And, all the land plays that we have going on are in question, right? Yeah. On value, on where they're at. So that you're right. That's the biggest change. And is it 10%? Is it 50%?
Is it 10 to 50?
I mean, that 50 they shocked me, I think, as much as it shocked you to hear that.
Yeah.
Because I don't think we've seen that. I'm not arguing that it may not be there. It's just I don't think we have the data points to really say how this interest rates and potentially two more interest rate bumps coming.
Yeah, and I think that's the hard part with land is you don't know where these interest rates are going to stabilize. You don't know in some of these secondary markets when you're looking at land. You don't know eventually how that's going to impact big box demand from tenants, right? And building costs are still somewhat, up in the air. So land is hard right now, I think, for developers with all the moving parts. From a building standpoint, and we'll touch on this later as well, from a pure hey, we got a core building that we're selling. It's got some term left on it. I think that's going to be looked upon as a really valuable thing. Stability, I think, will become more of a factor compared to what we've seen over the last 5 to 7 years of, hey, we prefer a building with 2 or 3 years left on the lease compared to a deal that has 7 years left on the lease. So I think in this kind of unstable interest rate market, stability will matter more.
Well, it's interesting you say that because if you look at this quarter, stability, land aside, we've established that that's been the biggest potential impact to this situation.
Yep.
I would say the second biggest impact, and I agree with you that it's got to be temporary, is the lack of value for a long-term stable asset. And obviously the reason is, for the most part, and we've seen this, that inflation is going to outpace the growth. Right. Of the whatever the percentage of increases that was negotiated. And rental rate increases year over year is forecasted to still be bigger than those growth. So they're valuing that 1, 2, 3 year remaining lease over a stabilized 10-year. But I agree with you. In an unstable market that seems to be heading down, wouldn't you value a long-term good stable tenant versus potential vacancy?
Yeah, that's funny. And I think we'll start to see some more of that. I also think when I talk about, we talk about stability, and we saw this, in the previous, slowdown, core markets. You think of markets like the Puget Sound, our market, right? Southern California, New Jersey, parts of Florida, the really good core markets that have always performed really well. There's going to be continued, investor demand to be in those markets because they know it's safer than some of these tertiary markets where they may get a better return, but your downtime is going to be a lot longer, especially in a downturn. When the market's hot and everything's leasing up, right? Big box product, and you can go, a couple 100 miles out from a key market and still lease that building. That becomes less of a play, I think, for investors in a market that's slowed a little bit from an investment standpoint.
Yeah, that's a great point. I think Seattle remains to be one of the hottest capital market structures, and we're seeing we even closed on one this month at a 3.26 cap rate.
Yep.
We're still seeing, buyers out there that are wanting great location, great tenants, great value, but recognizing there's a little bit of a change there in the market. It's just interesting, again, going back to that spread of how people are trying to understand it, because we don't have all the data points to say, did the market move 25 basis points? Did it move 40 basis points? Did it move more?
Yep.
I would say that we've seen it in our stuff that we're selling, maybe a 25 bip to 30 bip spread.
Yeah, I think that's right. And that's probably right for our market, and maybe it's more in others.
Agreed.
But yeah, I think that investors are trying to figure that out too, right? And so there's some that are still very bullish in our conversations of, hey, we want to be in this market. They may not be having the same conversation in other markets, but they know Seattle's safe. So fortunately for us, that's, we've been okay and have still traded everything on the capital market side. But I think it's important, as we look at the investment side, the leasing fundamentals, right, are a big reason why folks are still so bullish on the Puget Sound. So our second dynamic factor that we want to talk about was, although interest rates, are doing what they're doing, the leasing velocity in our market is still really strong.
And that's the crazy fact that you're right. We have all this demand and everybody's forecasting rent growth, and we're seeing it.
Yep.
And we're seeing, good annual increases. You're seeing all this. But you've got this dynamic that has nothing to do with the fundamental performance of industrial real estate. Interest rates, right? It doesn't affect demand right now. It might, but it is impacting the perception of the value, even though the market's red hot. You're going, well, why? Why are you changing your underwriting so drastically when the demand is crazy?
Yeah.
And rent growth is crazy. And so it is two strange dynamics that it'll be interesting to see how this all fizzles out in the coming quarter or two.
Yeah, and in our market, when you look at tenant demand, there's certainly still big box demand that's there.
Massive.
There's very few buildings above 300,000 square feet that are actually available.
Yeah, we've leased several of them ourselves, and we saw the last couple, a fight over them.
Yep.
And, we were on both sides winning and losing on those, but, competitive situations. And now, south of Seattle, you don't have anything standing, north of really 250 that's readily available.
That's right.
There's a couple out there that there's some lease expirations and things, but so you've got a huge demand, I think, in that, call it 250 to 500 range.
Yeah.
Really, really good demand with no product. And then you do have a little bit of a gap in the 1 to 200 range with a little softer deal velocity and a lot of product. We counted these the other day, and between Kent and Frederickson, between 1 and 200,000 feet of existing and that will be delivered in a time that right now a tenant would be looking at that building. So call it by Q2. There were about 49 options, with the majority of them being north that are sitting a little bit. So that Kent region, I think, including a few cities, had about 29 of those options. So a little bit of a gap.
Yeah, and that makes sense simply because a lot of those buildings, as they were developed, were built in that size range. And the positive side of that is generally where a lot of our tenant demand tends to be. So that may sound like a lot of options, but there's usually pretty good demand in that size
It's also
range.
where the velocity usually is.
Yeah, exactly.
It's just a little bit of a blip.
Yeah, and I remember the last downturn that we had. Not saying we're in one right now. I don't think we're there. We're calling it a downturn yet. But the 50 to 70,000 square foot range was brutal. It was brutal the last go around. There was a ton of options. I remember in that size range that were available. And then once it switched, those things leased up quickly. But that was the segment then, and now it's kind of like, okay, we have the same issue, maybe not quite to that extent that we had the last time, but there's a lot of 100 to 200 options out there for tenants. But again, good tenant demand. So that is helpful.
It's a great point, because when we did that study in the last downturn, we had, I remember, just under 4 years of supply of 50 to 70,000 feet.
Yeah.
And it took some time to absorb that. I agree with you. This is not anywhere near that. And it's a much wider region, because our market has expanded quite a bit since our last downturn. So that region covers a much bigger area. And I think historically there's been a lot more tenants in that 1 to 200 range across that region than that specific size range in the last downturn.
Yeah, and tenants have gotten bigger, right, since then, right?
That's
It's
right.
just the companies have grown, so it makes sense that will absorb quicker than the 50 to 70s the last go around. I also think that when you look at call it Tukwila through Tacoma areas, there's still really good velocity in that size range. So, it's a matter of time before a lot of that product, I think, goes away.
Yeah, and to our point, that the mass majority of the inventory is in the north part of the market that has been a little bit slower. When you look at the absorption, the number one cities over the last 36 months, and certainly this year, will record in that, Lacey, Frederickson area will be number one, number two. And then Sumner's actually popped back up with some deals, and obviously some availabilities that's getting leased up at Seaport.
Yeah.
And so Sumner's popped up, I think, back to about 15%. It was down to 9%. Prior, as you know, for a long time, it was around 40% when there was lots of construction going on there. And Kent's been a little bit slow.
Yeah.
Right?
Yeah.
So that goes right in line with what we already knew about that. But overall demand, I would agree, is strong. I wouldn't call it as strong as it was 6 months ago, but I would call it, historically in our career, strong.
Yeah.
Right now, with good dynamics, and in many categories, especially if you've got a building above 250, you're in for a long time, even with what's under construction, and we can dive into that, you're safe, right?
Yeah.
You're going to get rent growth, you're going to do well, you're going to lease, and you should build if you have land available above 250.
Yeah, that's right. And I think a lot of the absorption in those markets is simply because that's where the big box product went. And so, those big tenants are going to those particular markets, Frederickson, Lacey, DuPont, and the Valley kind of continues to just hum along at hey, knocking out 50 to 200,000 footers, day after day. So, but that's where our market's been. The other dynamic that we want to talk about is, 3% of annual increases were the norm for the last 10 years, right, in our marketplace. And now, no question, the new norm is 4%, and you're seeing some landlords push 5%. In some of the other markets, you'll see 6-7% annual, Southern California annual growth. So, no longer the days of 3% are over. So the new norm is 4%, and we'll see how far that climbs here over the next call it 6 months or so.
Yeah, and I would say over the coming months, I wouldn't be surprised to see, if buildings are delivering in that 300,000, 400,000, 500,000 foot range, because there's so few of them and there's such demand. I wouldn't be surprised if it was above 4%, but I wouldn't be surprised to see below 4% in that 1 to 200 range in certain categories, right?
Yeah, 3.5, 3.75.
Yeah, that's
but
right.
But I don't think we're going back to 3.
No, I totally agree with you. Yeah, absolutely.
Yeah.
And then the last thing that we have, as always, are 3 dynamic factors and 1 opinion. And that opinion is open for debate, but it's investors will start to look at long-term leases again as a value versus this short-term WALT, right? And it's been a head scratcher, but man, I can't imagine going into what I think we all feel. I think soon we'll officially be in a recession. I think we're going to have continued interest rate growth. And, I think we're going to be into inflation for a little bit. So in an economy that is going this direction, as I mentioned earlier, how could you not value stability, right? But I think we need to create stability in interest rates and understand that before the capital markets say, yes, we value that. We have to understand what that looks like, right?
Yeah. And I think once interest rates do stabilize, wherever that is, right? The money to invest is still going to be out there wanting to get really aggressive, right? It'll just be the new norm for aggression. So I think, we have certainly sold deals. We sold a couple deals in Spokane, big deals that had, basically 20 years of term on it, right? And so there's buyers out there that have, looked for stability. I think that there will be more, rather than the value add buyers, which they're still there too, clearly. But I think there's going to be more investors looking for those stable assets compared to where we've been over the last couple of years, and being very happy with a 5, 7, 10-year lease in place, over these next, call it couple years.
That's right. And what were the annual increases on those?
The Spokane ones were like 1.5 or 1.25.
1.25.
Yeah.
And we did very well with those. And to your point and to our prediction, people are going to be seeking stability. And so I'm not saying everybody's going to rush out and buy a 10-year lease with 1.25% annual increases, but they're going to be rushing to stable, good located properties with good credit tenants on long-term leases.
Yeah, there's no question. And then, I think it also depends on the location, right? I mean, if you're in the valley, you're not afraid of near-term lease roll, right? Whereas if you're in a new market that's just getting developed, stability will obviously be more important. But we have 2 deals right now that we're selling. One we just brought out in Everett that's got 11 years of term left on it. And the response so far, even with the interest rates doing what they're doing, has been really good.
Good.
So we'll see how that continues. But the response has been really favorable so far. Great demand. And then we're selling a deal in Sumner right now that's under contract that's got 6.5 years of WALT on it, and that's going to perform
with massive
really well.
activity on it.
Yeah, that had great activity, and that's going to perform well. So we're seeing the demand still be there. The depth there may be a couple groups that are hitting pause, but there's still a really good, 8 to 10 to 12 very interested groups and that we expect to see offers from on some of these stable deals that we have out there.
That's right.
So we think Q3 from a leasing standpoint is going to be strong, continue to be strong. I think we've absorbed about 4 million feet to date with leases committed to for the first half of the year, which traditionally is more than we typically do in a year. Last year, we did about 10.8 million. And I don't know if we'll get there, but I bet we'll get close this year, which is, last year was a record year. So leasing velocity we expect to continue. And it'll be interesting to see where these deals that we have out trade at, but we expect them to be good numbers. So we will report back on those on our next podcast.
Well said. Appreciate everybody listening, and enjoy the rest of the summer.
See ya.